Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 126 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, what we are going to talk about is dividends and share repurchases and how they impact your investing life. And this is an extremely important topic that I think really gets missed when it comes to discussing your investments extremely often. So I think we should really explore this idea of dividends, explore what they are, how they can be used, how they should be used, and what impact they can have on your long-term investment returns. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be glad to get back to you there as soon as I can. If you're listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's good supplementary materials to all the things that I'm putting out on these daily long form episodes on YouTube or the podcast. And then if you need somebody to help you to create a financial plan that is specific to you and your family and that can keep you accountable to that plan over the long term, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, let's just start as simply as possible. What is a dividend? And we've all heard people say over the course of our lives, it pays dividends to do so-and-so. And they've turned this idea of dividends into just a common phrase that individuals use. But what are they in terms of your investments? Well, what a dividend is it is a distribution of money from a company to its shareholders. And that distribution of money comes from the company's earnings. And this distribution must be signed off on by the board of directors of whatever company that we are talking about. And as we know, there are two different types of stock. We know there is preferred stock and there is common stock. Well, preferred stockholders, they tend to get into preferred stock for the dividend. The dividend is very important to preferred stockholders. And that is just kind of the nature of what preferred stocks are. But common stockholders, which many more of us are, can also receive dividends. And so I want to talk about exactly how that occurs and how that can have a long-lasting impact on our investing lives if used correctly. Now, when companies have to make decisions about the money that they have, they really have two options. They can say, okay, we'll either take the money that we have and keep it in the business and reinvest it in the business and continue to try to grow internally, or you can return your capital to shareholders. And dividends are one way that capital can be returned to shareholders. It is going to be a direct cash payment. And so typically what individuals look at when they're looking to receive a dividend from a particular stock is what's called the dividend yield of that stock. Now, all this means is it is the amount of the dividend divided by the current price. And when I say the amount of the dividend, I do not mean the periodic dividend, because dividends are typically paid on a quarterly basis, but I'm talking about the annual dividend. So the total annual dividend divided by the current stock price gives you the dividend yield. Why is this important? Why is the dividend yield important to an investor? Well, because that tells the investor that if I were to hold this stock for 1 year and nothing happened to the price, I know that I can gain this amount from the dividend alone. And this is important in determining what our return is going to be on that particular stock, because as we know, there are only two ways that we can get some type of return from a stock. You can either get capital appreciation, a capital gain, meaning the price of the stock went up. So we look for that, but you can also get some type of return of capital to shareholders. And in this case, we're talking in the way of dividends. And so you can have a dividend yield and a capital gain, and that will give you your total return on a particular stock. So that's why the dividend yield is so important to know and understand, but it gives us an idea of what could we make off that stock just from dividends. And obviously not all companies pay dividends. A lot of companies, especially now, do not. Dividends are not something that are as common as they used to be. Some of the largest companies in the world do not pay dividends. Amazon does not pay a dividend. Berkshire Hathaway does not pay a dividend. And this is not necessarily bad for their shareholders because those shareholders can still make money through capital appreciation. But specifically with Berkshire Hathaway, it brings me to the next part of how capital can be returned to shareholders that I wanted to talk about in this episode, and that is the share repurchase. In a similar way to being able to take money from earnings and pay it back to shareholders in cash in the form of a dividend, what you can also do as a company is you can institute a share repurchase program, or you might also hear them called share buybacks. And what a share buyback is in a similar way of taking your retained earnings, taking the earnings that you have in the company and paying them out. You will take earnings that you have and you will repurchase shares of your company stock from the market. Now, what does this do and why is it important? Well, what it does is it decreases the number of shares outstanding in the market. And when you decrease the number of shares outstanding in the market, then what you also do is you increase the per share earnings of the company, because they take their earnings divided by the amount of shares that they have outstanding. And so the earnings per share will increase because you decrease the amount of shares that are available in the market. Not only that, when you're talking about the price of a stock, you are talking about the price per share. Well, if you decrease the number of shares, then the price will increase. And so what share repurchases do for the investor is they find this increase in price, this increase in the value of the stock that they hold. And so this shows up as a capital gain. It shows up as an increase in the stock's price, but it's really a way that firms are distributing capital to their shareholders. And the reason that they would do this instead of just paying a straight dividend is because dividends are something that investors come to expect. Dividends are something that the stock may hinge heavily on. So if you initiate a dividend, typically you don't want to take that dividend away. And not only do you not want to take it away, in a lot of cases, investors are going to want you to grow that dividend over time. But the upside of the share repurchase is that it is far more flexible. You can choose, given whatever market conditions there are, to repurchase shares from the market if you are a particular company. And you can repurchase those shares. Typically, what you would want to do is repurchase those shares when the shares are undervalued, right? Because that would be a good use of the firm's capital to buy your undervalued shares. And so you buy the undervalued shares, thus lifting the per share price for all of your shareholders. But you're not tied down to that. You're not tied down to share repurchases. You're not tied down to doing that over and over and over again. You can do it once. You can never do it. You can say that you're going to do it and not do it and not be in trouble for that. Yes, your investors may not like that, but there is no obligation to continue a share repurchase program past what you say or even up to what you say you are going to do. And so share repurchases can provide a lot of flexibility for a company, and it's a good way that companies can return capital to shareholders. And like I said, this is something that Berkshire Hathaway likes to take advantage of because they do not pay a dividend. And Warren Buffett says all the time, one of the best uses of capital, if you don't have any acquisition target within Berkshire Hathaway, if the stock's undervalued, then they will just repurchase their own stock, thus lifting up the value of shareholders, which is what they're trying to do in the first place. So you see the value that can be added there as well. And with the share repurchase, you don't really know exactly when the repurchases are going to occur. They tend to actually occur over a period of time, over a particular quarter or multiple quarters. And you don't know exactly when the firm is repurchasing shares within the daily volume of the stock being traded. But when you announce a dividend, then there are specific dates that have to be kept up with a dividend. And so one of the important dividend dates is the announcement date, which this is when the dividends are announced by the company management, and they must be approved by the shareholders before they can be paid. And so that is the first date that you would see is, okay, the dividend is announced. But then there's what's called the ex-dividend date. And the ex-dividend date is the date on which the dividend eligibility expires, right? And sometimes they call this just the X date. And so what this means is if a stock has expired, let's say on a Monday, then shareholders who buy the stock on or after that day will not qualify to get the dividend. So even though the dividend has not been paid yet, if you didn't own the stock before that day, then you do not end up getting the dividend. So that's a very important date for investors because a lot of investors will try to buy stocks before their ex-dividend date in order to receive the next dividend that will be paid. Then there is the record date, right? And the record date is the cutoff date established by the company in order to determine which shareholders are eligible to receive a dividend and or a distribution and which ones are not. And this is just the date on which they go through. And this is very close to the ex-dividend. And those go through and they'll say who's getting it and who's not getting it. And then obviously there is the payment date. And that would be the date on which the company is actually going to give the dividend to the individual shareholders. And that's the date that everybody looks forward to. But you have to understand the other dates in terms of actually investing in the stock and getting the particular dividend. Now, so we've seen how share repurchases have a direct impact on the price of a stock because the price of the stock will increase given the amount of the share repurchase that was completed. But dividends can also have an impact on share price. Why? Because this is an amount of earnings that is leaving the company's books and being paid back to the shareholders. And so dividend payments can impact share price. So the share price may rise on the announcement approximately by the amount of the dividend declared and then decline by a similar amount at the opening session of the ex-dividend date. And the reason that this is because obviously if you're providing value back to shareholders that they didn't expect to receive previously, then that would be a positive thing for the shareholders. But at the same time, once the ex-dividend date is hit, then you know that that particular dividend is going to be paid out. Therefore, the share prices will decrease by the amount of the dividend. And obviously, this doesn't work out perfectly because there's trading going on other than that just based on the dividend. And so this would occur and you will see price fluctuations based on what the dividend is and when it is going to be paid. Now, most dividend paying companies are far more stable in their earnings. They're far more stable in their stock price. Their stocks tend to have a lot less volatility. Why? Because as I said earlier, dividends are something that shareholders come to expect, and they come to expect you to grow those dividends over time. And if you are a company that doesn't have much stability or the ability to return capital to shareholders on an ongoing basis, it is going to be difficult for you to keep your shareholders happy. And so the companies that end up paying dividends and doing so over a long period of time tend to be larger companies and typically companies that have really strong balance sheets and have a good cash position and are bringing in earnings systematically that can take care of that dividend obligation that they put out there. Now then you may say, okay, well this is all fine and good and nice, but what about my returns? What about when I invest and receive dividends? What does this actually look like? Well, I know we've talked a lot about fund investing, and when you are investing in a mutual fund or an index fund or whatever it may be, you will likely receive dividends within that fund as well, because there are going to be companies within that fund that are paying dividends into the mutual fund, back to the mutual fund company. Then the mutual fund will pass through those dividends to the shareholders, you, right? They will pass them back to you. So you will receive those cash dividends back. And if you buy individual stocks, if you buy stocks that have dividends, then they'll pay you a dividend. If you buy stocks that don't, then they will not. And what this needs to look like in your portfolio over the long term is you need to take these dividends and don't take them off of your account. Don't take them out of whatever account that you have and use them as income. A lot of people use dividends as income, and that's perfectly fine if you're in retirement or in a place where you need the income, okay? But if you're in a place where you're just trying to accumulate for the future, taking dividends off of your accounts can be extremely dangerous. And just having your dividends paid into your account and left as cash can be extremely dangerous as well. What you want to continue to do is to reinvest your dividends. And I will show you the importance of doing so, okay? So over the past 100 years, okay, from January 1921 to January of 2021, where we are today, you have seen the S&P 500, the return on the S&P 500, if you just looked at price, if you just looked at the capital gains, the increase in price over time, the return you would have received is 6.474% annually, okay? Which is not a horrendous return, but you're like, hey, Dylan, I thought you said you can get 10% returns in the S&P 500. What the heck? Why is this not a 10% return over a 100-year period? Well, because you didn't take dividends into account. If you take dividends into account and reinvest your dividends back into the S&P 500 over that 100-year period, you end up with a 10.646% average annual return. That is almost 4.2% difference from just the S&P 500 return that does not take into account your dividends, that just takes into account the price. But if you're talking about your dividends being reinvested, you could have picked up an extra 4.2% annually, compounded over 100 years. And so that is a very, very substantial amount that dividends can do for you. Now, over time, dividend yields have declined, and a lot more companies are choosing to do things like share repurchases. But a lot of companies still do pay dividends and still do so in a way that will benefit you over the long term, because that is money that is being put into your accounts that you can then reinvest and buy more and buy more and buy more. And as you have more money, your dividends are going to do more for you because you will receive more in dividends, and therefore it will buy more of whatever you have if you are reinvesting those dividends. Because that's the thing, we always want to keep our money compounding. And anytime that you take the dividends off of an account, you're not allowing your money to continue to compound. What you're doing is you are taking that cash out. You're taking out that cash that was put into the account, or you're just leaving it in cash, and it is not growing for you as well, because that's the key. Keep those dividends growing with you, as well as continuing to receive new dividends over time. And that's how you really grow your long-term wealth. And obviously, it makes a huge, huge difference over a long period of time. Now, if you say, oh, well, Dylan, you said that, dividend yields have decreased over time, and, is this still relevant? That's a 100-year period. Is this still relevant? Well, if you just look at the last 20 years, okay, you look at the last 20 years, the S&P 500 return without dividends reinvested is 5.323%, okay? But if you were to have reinvested dividends, it would have been 7.34% annually. And so you're still picking up over 2% annually just by reinvesting your dividends. So I would say this is still extremely relevant, and it is still something that is going to allow you to make good returns over time. And you got to think, yes, those are lower than the 10% return that I've talked about previously, that is the average annual of the S&P 500. But you have to think, since 2001, we've had a tech bubble pop. We've had the financial crisis. We have had the coronavirus pandemic crisis and the drop in share prices that was quite precipitous at that time as well. So we've had multiple crises since this time, and you still could have picked up 7.34% annually compounded if you would have just reinvested your dividends in the S&P 500. Now, I alluded to it a moment ago, but I want to jump back into, if you are a retiree, if you're somebody who is needing income off of an account and you want to create that income via dividend payments, then you can definitely do that. And I talked about preferred stocks just a bit earlier. Preferred stocks may be a way for you to do that and receive income that you would need. You can also receive income off of bonds. But dividend paying stocks that can provide you upside capital appreciation that preferred stocks and bonds are not going to offer can also be a very good option as well. And you can take that dividend off systematically in order to pay yourself the income that you need. And you can determine, right? We've talked about withdrawal rates. If you determine what your withdrawal rate is, and let's say you just want to invest in dividend paying stocks or things of the like, and you know how much you're going to need as a percent of your assets, then all you have to do is determine, okay, what dividend yield do I need to have as a total portfolio in order to pay me the withdrawal rate that I need? Because your dividend yield would become your withdrawal rate in that case, and it would just pay you out whatever you needed systematically. So that is a way you can get retirement income, and you can take care of your your idea of the withdrawal rate. Obviously, owning just stocks at that point may not be what is best for you, but out of a percentage of your portfolio, you can definitely do this and take the income that you need if that is something that you believe to be worthwhile for you. And obviously, any companies that you invest in or any funds that you invest in, just make sure that they can continue paying you over time and that they are of good quality and will continue those dividends because we don't want to be messing around with our retirement income. Now, we'll also give you a couple of ways to be wary of companies that pay dividends. And there's just a couple different things you need to keep in mind, especially if you invest in individual stocks that you need to keep in mind when you are investing in dividend paying stocks. One, if the yield is too high, it may not be sustainable. So what do I mean by this? Well, I've heard Jim Cramer, who's on CNBC, talk about, if the yield is greater than or equal to 8%, that can be a number that is really scary. And I may even ratchet that down to, the 6-7%. Any yield greater than that may not be sustainable. And the reason being is because if you're talking about that being the yield, then that means that relative to the stock price, the dividend is extremely high. And maybe a company can sustain that, but if the company were doing well, if the company were performing well, then what would be occurring is the price of the stock would be systematically rising, and you wouldn't be paying out such a high percentage in the way of dividends. So sometimes what will happen is a firm will be struggling to produce the earnings that they need to produce, and the stock price will fall precipitously, and you'll see this big increase in yield, but it may also be paired with a dividend cut because they can't keep up with that large yield that they are promising their investors. And so that may be something that you need to look out for. And then you also may want to think about the fact that if a company just initiates a dividend, then what does that mean? What that means is that that particular company has found no other internal use for their capital and finds that the best use of their capital is to return it to their shareholders. Not a horrible thing, but it may mean that there is a lack of ability to grow over time. Because like I said earlier, the companies that tend to pay dividends and in the heftiest amounts are the large, stable type of companies. And so they don't have as high of growth rates as other companies that may not pay dividends and may be reinvesting into their company systematically. So you may want to just keep in mind that if a company is initiating a dividend, it may not be a bad thing, but it may indicate a slowing of their growth and their ability to continue to increase their share price over time. And so that can tell you something about that particular stock. Now, if you want it for the dividend, that's perfectly fine, but that may not be the only thing you want. You obviously would like some capital appreciation as well. So buying a stock just for the dividend can be dangerous. And when a stock initiates a dividend, it may mean something negative as far as growth. Now, what do I think about dividends and repurchases when it comes to my own portfolio? Well, I believe that dividends are a good thing. And I believe share repurchases are a good thing. Why? Because they are returning capital to shareholders. And as a shareholder in a company or a mutual fund or an index fund, whatever it may be, what you want is you want capital returned to you in some way. Now, obviously, the only other way that we can get it other than some type of distribution or income is by the capital appreciation of our particular shares, the increase in price of the shares that we own over time. And so obviously we want to see that occurring, but I like being paid dividends in some way, shape, or form. For instance, if you're in an index fund, the S&P 500 index fund is probably going to yield you. I mean, we were looking at those numbers right now. It's probably yielding you less than 2%, but maybe somewhere around 1.5% to 2% maybe a yield that you find in the S&P 500. Well, that's an extra 1.5 or 2% that you weren't going to get paid otherwise just by the increase in price. And we can compound that money and push that money and reinvest that money back into shares over time. So I see that as an extremely positive thing, especially in a large diversified portfolio like an index fund, a mutual fund, things of the like. Now, obviously, we like share repurchases. Share repurchases make a lot of sense because even if the company has some type of growth opportunities available to them, right? They obviously want the highest return for their growth opportunities. And if their stock is undervalued, see, it's the same thought process that an investor needs to have, an individual investor needs to have, is that, if a stock is undervalued, you want to find the stock that is the most undervalued and that can give you the most upside potential. Well, with a company, they can look at their own stock and go, okay, does our own stock have more upside potential than a particular growth opportunity or something we could invest in over here, a new business, a new part of our business, whatever it may be. Can our existing business actually increase in share price faster? And if they say that that is the case, then obviously you would buy the underpriced shares and repurchase shares from the market, which as an investor, I love. Why? Because the prices of my shares will then rise. And that is something that you want to see occur over time. So companies that return capital to shareholders in the way of repurchases is a huge, huge deal. And it can really have a profound impact on your returns over time. Now, obviously, you want your company that you own or the companies that you own to be growing in some way internally, right? You don't want them to just exclusively repurchase shares, but that can still be a great way. If they have the cash to do it, they have the earnings to do it, the financial position to do it, that can be a great way that you can increase your returns over time. And it is up to the discretion of the company. And so for me, that makes me think even better of a company that decides to do it because they don't have to. They don't have to return that capital to you in any given way. But the fact that they're choosing to do it means they are making an investing decision within the firm that is going to increase the value of the shareholders and is going to increase shareholder wealth over time. And that is something that we like. That is what we want when we are investing. Now, the bottom line of everything that I have to say to you today about returning capital to shareholders, whether it be in the way of dividends or share repurchases, is that we like it, right? We like capital being returned to us because we can reinvest that capital, or the capital will increase the price of the holdings that we currently have. So whether you own a common stock that is paying you dividends, an MLP, a master limited partnership that's paying you dividends, a preferred stock that's paying you dividends, whatever it may be, dividends can be extremely useful as long as we are keeping them compounding and as long as we are using them for what we need, and especially if we are in retirement and it is creating the income for us that we need and the returns that we want over time, then dividends can be a very good thing. And then obviously, if you own companies like Berkshire Hathaway, you own companies that are repurchasing their shares systematically over time, and they are increasing the value of their shareholders over time, then that is awesome for an investor, and we love to see that as well. So overall, returning capital to shareholders, good thing. There are little things to look out for, but overall, we like this, we want this, and we just want to continue to grow our money in any way possible. And any free money that companies offer us, we will for sure take it. So thanks for tuning into this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review on either one of those platforms. And then follow me on social media at MNO with Dylan. And that's good supplementary materials to the long form episodes on YouTube and the podcast that I'm putting out daily. And then if you need somebody to help you in your financial life to create a plan and keep you accountable to that plan over the long term, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and we can begin working towards your long-term financial goals together, given whatever type of financial coaching session that you choose. So tune in tomorrow as I talk about value investing and why this particular type of investing can be so beneficial over the long term. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.